Good afternoon, my name is Gabriela Diaz, and in today's class, we'll be covering Chapter 9 about profit maximization and supply. So, we'll be covering two aspects. First aspect is how firms make a decision on how much they need to produce, which is our output decision for price taking firms. And the second aspect is how firms determine their profit, which is the profit maximization for price taking comparative firms. I usually like to divide my classes into the concepts, the equation. I also like to put real life scenarios so we can relate the concept with, what happened in our daily life. And at the end, I always like to share a graph so we can, relate our equations and the definitions, and how we can represent that graphically. So let's start by some definitions. We are talking here about price-taking firm. So what is a price-taking firm? And that's gonna lead us to what is a perfectly competitive market. A perfectly competitive market is a market where there are many firms. So these firms that we are seeing here, these individual firms' output do not have any kind of impact into the market equilibrium. Output is then identical across firms because all these firms have the same access to technological resources, they have the same access to inputs. And the consumers have perfect information about prices. So the consumers know everything about prices. And we also said that the price for the firms for the perfectly competitive market, there are price takers. So they have no ability to influence the price the market are gonna pay for the products. So they have to take the price the market offer them based on the laws of supplies and demands. And also all these firms, they are strictly motivated by profit. So after we know about some definitions, of the equations, we'll be talking about the definitions of price-taking firms and competitive market. We can go to the equations. Firm profit is the difference between the total revenue and the total cost, like we are seeing here in the equation. Now, the total revenue, let me move this, will equal the price of each good multiplied by the quantity. So we have profit equal to total revenue. We have the equation of total revenue here at the bottom minus total cost. Now, this total cost is basically the economic cost. We have two different types of costs. We need to understand this. We have the economic cost and we have the accounting cost. So this cost that we're here in the equation will be the economic cost. Now, what's the difference between economic cost and accounting cost? Usually the accounting cost is the one that we're gonna see in a spreadsheet, where it mentions all the expenses and all the costs. And the economic costs are those costs that includes the opportunity cost. It's basically the implicit and the explicit. When accounting is just the explicit cost. Now, this economic cost that includes the explicit and implicit and also the opportunity cost is going to lead us to our class before of what is an opportunity cost. The opportunity cost of something is what you gave up to get that something. So the opportunity cost will be the next best alternative that you gave up to get that something, to get that item. Let's go back and put a real life scenario. So let's put a scenario on the difference of economic cost and accounting cost, which is, remember, the economic cost is the one that we're seeing here in the equation. So let's go to the example. My husband, 5 years ago, he decided to open a business. Let's put this scenario. And the business was doing $240,000 every year. From those $240,000 every year, $150,000 were expenses. So those expenses were electrical costs, vendor costs, rent, employees. So from those 220,000, if we take this 150,000 in expenses, we have an accounting profit of $70,000. So that was our accounting profit. Now, 2 years ago, one of my husband's friends offered him a job in marketing at the radio. The job, he was going to do $90,000, $70,000 in salary, plus incentive, plus commission, $90,000, around $90,000 in total. So he had to make a decision if staying with his business or going to work with his friend. If he wanted to stay with his business, his economic cost will be the $150,000 of expenses of his business plus the opportunity cost, the $90,000 opportunity cost of salary in the radio. So the total economic cost in this case will be 150 plus 90 will be 240,000. Now, what will be the economic profit? Will be the 220,000 that he was making on his business, less those 240,000 economic costs. We will give us negative $20,000. Then yes, if he kept if he wouldn't kept with his business, he wouldn't be making $70,000 accounting profit, but he was going to be making negative $20,000 economic profit. So that's the difference between those two costs or those two profits. It's basically one of them also take into account the opportunity cost. So in this case, my husband just decided to go with his friend. And I mean, in this scenario, it was the best decision because, you know, like I said, in this case, we're taking into account the opportunity cost. So let's go back to our equation after, you know, we were able to put that real life scenario into the two different concepts. One more time, the profit will be the difference between total revenue and total cost. And let's go now to this equation. Total revenue will equal the sale price of the goods multiplied by the quantity. So we said total revenue divided by quantity, it will equal the price. Let's keep that in mind. So let's go to a term now of marginal revenue. Marginal revenue is refers to the change in total revenue from one unit change in quantity produced. So marginal revenue will equal the average of total revenue dividing the average in quantity. Now, do you remember that we said here that price would equal total revenue divided by quantity? So we can conclude in that case that price will also equal marginal revenue for this kind of firms. Because one more time, marginal revenue will equal the average between total average and the average divided, by the average of quantity. Same thing if we set price here will equal total revenue divided by quantity. So at this point, we can conclude that price will be the same thing as marginal revenue. And that will lead us to the last part of our class, which is basically our graph, where we can see the price in this kind of firms, in this kind of graph, will equal marginal revenue. And we also have the marginal cost. And this graph is just to show us that the firm profit maximizing level of output is where marginal revenue equal marginal cost. So the maximizing level of output and the firm's profit will be this point right here. And we can also arrive to the conclusion that if the price goes up, the production will increase and the quantity will increase. And if the price goes down, the production will decrease, as not the quantity. So we can look at some other equations and some other graph and some other samples. So I invite you to keep reading the book and keep looking at all these concepts. And I will see you guys on our next class. Thank you.